Welcome to Illuminati Silver. We tell the truth about silver. Today is Sunday the 14th of March 2021, and we're looking ahead to the FOMC meeting due on Wednesday and what this could mean for the US dollar and potentially gold and silver prices. So let's take a look. Now, yesterday we published our gold and silver weekly update for the weekend in the 12th of March, and today, Bitcoin versus gold and silver, episode 15, $60,000 Bitcoin, and we place links to both of these below. Now, on Tuesday and Wednesday of this week, the FOMC of the Federal Reserve Bank will be meeting, and on Wednesday, the FOMC will make an announcement on interest rates and bond buying. And Fed Chair Jerome Powell will be giving his usual press conference after the announcement. There is, of course, much speculation surrounding what the Fed will do, especially having recently experienced increasing interest rate yields. Much attention was directed towards the ECB in the last week or so, when it was generally felt that it may, too, have to embark on significant increasing in its bond buying program in order to keep rates low. There was much speculation that the Fed would also be forced to do so in light of continuing rising yields and further strengthening of the US dollar. Now, Bloomberg published an article surrounding this issue earlier today. This is what it said, quote, "Investors are again reassessing one of the bond market's premier reflation trades, the curve steepener, as expectations for growth and inflation perk up at a clip that was hard to imagine just a few months ago. Whereas back in December, the thought was that the Federal Reserve might tamp down long-term Treasury yields, the issue now lies with shorter-dated ones, 5-year rates. Yields on that maturity have become unmoored in recent weeks, surging amid speculation that the central bank will need to start a cycle of rate hikes, perhaps a full year earlier than officials have indicated. That shift has roiled the outlook for a classic iteration of the reflation wager, a widening gap between 5 and 30-year yields, even as the narrative of a stimulus-fueled recovery has only gained momentum. The key takeaway is that the bet on a steeper curve isn't kaput, because yields are still generally seen as rising further. It's just due for a rethink. For example, it may mean ditching the waiver if it's grounded on the 5-year note, which reflects a medium-term view of the Fed's path, in favour of one based on the 2-year note, which still remains anchored in the market's eyes. This backdrop only intensifies the focus on the Fed's March 16-17 meeting, officials' next chance to counter speculation that tightening will begin as soon as late next year. The Fed next week will have to walk a fine line between either pushing back against market expectations or allowing them to stand, said Kevin Walter, co-head of Global Treasuries Trading for Barclays plc. Without Fed pushback, he said, there might be more pressure on the belly of the curve, in which case the best steepeners would be the spreads between 2-year yields versus 5- and 7-year rates that have room to rise as traders price in tightening. The swaps market is reflecting a roughly 75% chance the Fed lifts rates from near zero by around the end of 2022. Walter expects no major policy changes next week and anticipates that officials will continue to project rates on hold through 2023. If, though, the Fed does signal some 2023 hikes next week, the market will probably bring expectations for rate increases into the first half of 2022, and the 1-year forward 5-year rate could increase 50 basis points. Peter Chatwell, head of multi-asset strategy for Mitsui International plc, said in an emailed note. Fed Chair Jerome Powell gave just a minor nod last week to the bond market slump that drove 10-year yields above 1.6%. He emphasized the importance of financial conditions, which remain accommodative, although tech stocks did sink on Friday as the yields surged. 5-year inflation expectations at the highest since 2008 and robust jobs data have only reinforced bets that the Fed will need to tighten more quickly than it's been forecasting. The speculation has squeezed wages on a steeper curve from 5 to 30 years, shrinking that spread to a bit above 150 basis points from a more than 6-year high of 167 in February. The 5-year yield at 0.84% isn't far below its highest level since last year. But the 2-year rate has remained near historic lows on the view that the Fed will hold rates near zero for the immediate future. That's kept bets on the widely watched spread of the 10-year rate in play, as well as versus other maturities such as 5 and 7-year. Some steepeners are better than others, said Patrick Leary, senior trader and chief market strategist for InCapital. He expects the 2 to 10-year spread to keep widening, but has taken profits on steepeners and is looking for a better point to re-enter. Already, certain quarters of the market are turning their attention to the potential for multiple rate hikes. This is our comment here. Barclays are suggesting potentially as many as 5 to 7 prior to 2005. And while shorting treasuries has been in vogue, it's possible the market may have gotten a little ahead of itself in the belly, causing the 5-year rate to rise too much, said Jamie Anderson, head of US trading for Insight Investment, which manages about $1 trillion. If the data comes in weak or the Fed is on hold for longer than expected, the belly should rally and the curve re-steepen, he said. For InCapital's Leary, the narrowing in the 5 to 30-year gap came on the view that officials may discuss or even announce a twist next week. Such an operation, involving the sale of shorter-dated holdings and purchase of longer maturities to control yields, would put more pressure on the belly, he says. That would follow the European Central Bank's decision to ramp up its bond-buying pace. All these trades are highly dependent on the Fed being on the sidelines and not changing its policy stance, Leary said. The market is definitely playing a game of chicken with the Fed by testing how high yields can get before tightening financial conditions and forcing the Fed to step in. Unquote, end of article. So, if the Fed continues with its rather loose or dovish talk, then we could very well see gold and silver prices rise this week. If, however, it suggests rates may have to rise sooner rather than later, or that it won't embark on increasing its bond buying program, then we may very well see a fallback in prices as the dollar strengthens. Wednesday and Thursday's follow-through, though, could prove most interesting. Now, we have already given our price forecast for this coming week for gold and silver, with gold ranging generally between $1,600 and $1,800 and silver between $25 and $27, with outliers of $24 to $28. And of course, prior to Wednesday, there could be moves in anticipation of what the Fed may have to say. Also, we should not forget that we have a fair amount of economic data being announced on Tuesday, which could act as a precursor to any moves on Wednesday and Thursday. And this data includes retail sales, import prices, and the industrial production figures all for February, and business inventories for January. So as we have said earlier, we are expecting some price movements this week, but it'll be very interesting to see where the highs and lows for both gold and silver actually lie, and whether the continuing dollar strength is maintained, increased, or actually falls back. The latter, of course, being beneficial for gold and silver prices. What do you think? Are we going to see any significant rise or fall in gold and silver prices this week, and particularly after the Fed's announcement? Share your thoughts And if you haven't done so, do please subscribe to the channel. Thank you so much for listening. We hope you have found this video interesting and informative. And if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.